I'm staring at employment data that reveals something the government doesn't want you to know. We're already in an employment recession, and it's about to get much worse. The jobs report that just came out shows the US lost 105,000 jobs in October and gained only 64,000 in November. But here's what should terrify every working American. Jerome Powell himself admitted these numbers are overstated by as much as 60,000 jobs per month. That means we could be losing over 160,000 jobs monthly, while politicians claim everything is fine. This isn't just another economic downturn. This is the beginning of a systematic destruction of middle-class employment that combines the worst aspects of every previous recession: AI-driven job elimination, Federal Reserve policy mistakes, massive corporate cost-cutting, and government fiscal irresponsibility. And the people who will pay the price aren't the executives making these decisions. It's ordinary taxpayers who are about to discover that their job security, their wages, and their standard of living are all under assault. Let me walk you through exactly what's happening and why the employment crisis that started in 2025 is going to devastate working families while the wealthy and well-connected profit from the chaos they helped create. The unemployment rate jumped to 4.6%, and Powell specifically said this is the single most important data point the Federal Reserve watches when assessing labor market health. But unemployment statistics only capture people actively looking for work. They don't count the millions of Americans who have given up looking, taken part-time jobs when they need full-time work, or accepted massive pay cuts just to stay employed. From January through November 2025, employers announced over 1.17 million job cuts. That's a 54% increase compared to the same period in 2024. These aren't just numbers in a government report. These are real people losing their livelihoods while facing the highest cost of living in decades. But here's what makes this employment recession particularly cruel. It's happening simultaneously with accelerating inflation that's destroying whatever purchasing power working Americans have left. Wages are growing at 3.5%, while real inflation minus, not the manipulated government CPI number, is running at approximately 6%. This means that unless you got a 6% raise this year, you effectively took a pay cut. And it's about to get worse. The Federal Reserve restarted money printing on December 12th, injecting $40 billion monthly into the financial system. This will accelerate inflation while employment continues to deteriorate, creating the worst possible combination for working families: fewer jobs and higher prices. The money supply has reached an all-time record high and is growing at approximately 6% annually. Every dollar the Fed prints reduces the purchasing power of every dollar you earn. So even if you keep your job, even if you get a modest raise, you're still getting poorer because the money you're paid is worth less than it was last year. Artificial intelligence has been directly responsible for 54,694 job cuts in 2025. And that's just the beginning. Unlike previous technological disruptions that eventually created new types of jobs, AI is specifically designed to eliminate human labor across all skill levels. Entry-level positions that young people traditionally use to start careers are disappearing permanently. Mid-level management jobs are being replaced by algorithms. Even high-skilled professional positions are being automated away. The geographic concentration of job losses makes this crisis even more devastating for ordinary taxpayers. Tech companies, which had been driving employment growth and tax revenue in cities like San Francisco, Seattle, and Austin, are now leading the downsizing. When these high-paying jobs disappear, it creates a cascading effect throughout the local economy. Restaurants, retail stores, and service businesses that depended on tech worker spending are forced to cut their own workforce. State and local governments that became dependent on tax revenue from tech companies and their employees now face budget crises. This means higher taxes and reduced services for everyone, regardless of whether you personally worked in tech. Teachers, firefighters, police officers, and other public employees will see their jobs eliminated or their compensation frozen, while property taxes increase to fill budget gaps. Telecommunications led job cuts in November, with companies like Verizon eliminating thousands of positions while simultaneously reducing service quality. This represents a broader pattern where companies use economic uncertainty as cover to slash labor costs while maintaining or increasing prices. Customers get worse service, workers lose their jobs, but shareholders and executives see their wealth increase. Food companies are cutting jobs due to rising input costs, but they're not lowering prices, they're automating production and reducing workforce while maintaining profit margins through higher consumer prices. This creates a vicious cycle where job losses reduce consumer purchasing power, which leads to more job cuts as demand softens. Retail job losses reflect the reality that consumer spending is weakening despite government claims about economic resilience. When working families face 6% inflation with 3.5% wage growth, they're forced to reduce spending on everything except essentials. This reduction in discretionary spending translates directly into retail job losses, creating more unemployment and further reducing consumer demand. The nonprofit sector is experiencing significant job cuts as government funding gets slashed. These are often the jobs that provide social services, healthcare, education, and community support that working families depend on. When nonprofits cut staff, it's not just employment that disappears, it's the safety net that helps communities cope with economic hardship. Media companies continue to eliminate positions, reducing the independent journalism that could expose how bad the employment situation really is. When fewer reporters are investigating and reporting on economic conditions, it becomes easier for politicians and central bankers to maintain their narrative that everything is under control, while working families suffer. The restructuring and cost-cutting that drove over 200,000 job losses in November represents a fundamental shift in how corporations view labor. Companies are using AI, automation, and outsourcing not just to improve efficiency, but to permanently reduce their American workforce. These aren't temporary layoffs that will be reversed when economic conditions improve. They're permanent eliminations of positions that will never come back. Here's what makes this employment recession particularly insidious. It's being disguised as economic success because asset prices continue rising due to Federal Reserve money printing. Stock markets, real estate, and other financial assets are reaching new highs, while employment deteriorates and wages fall behind inflation. This creates a wealth effect for asset owners while devastating everyone who depends on wages for income. The Federal Reserve's response to weakening employment has been to cut interest rates and restart money printing. But this approach benefits financial markets and asset owners rather than working people. Lower interest rates make it cheaper for companies to borrow money for automation projects that eliminate jobs. Money printing inflates asset prices while eroding wage purchasing power. Powell's admission that job numbers are overstated by 60,000 per month means we could already be in a much deeper employment recession than official statistics suggest. If the government is systematically overestimating job creation, then policy responses are based on false information, making the eventual correction more severe. When reality becomes undeniable, the timing of this employment recession is particularly dangerous because it's occurring during a period of unprecedented government debt, international tensions, and technological disruption. Previous employment downturns happened when government had more fiscal flexibility to respond with stimulus spending. Today's government is constrained by massive debt loads and political dysfunction that prevents effective policy responses. Small businesses, which historically have been the primary source of job creation during economic recoveries, are being squeezed by the same forces affecting large corporations. Higher input costs, AI competition, reduced consumer spending, and tighter credit conditions make it extremely difficult for small businesses to maintain their workforce, let alone hire new employees. The generational impact of this employment recession will be severe and long-lasting. Young people entering the job market face elimination of entry-level positions by AI, increased competition from experienced workers who lost higher-level jobs, and an economy where traditional career advancement paths have been disrupted by automation. Older workers who lose their jobs face age discrimination in hiring, obsolete skills in an AI-dominated job market, and pressure to accept early retirement with reduced benefits. Many will never work again at their previous income levels, forcing them to liquidate retirement savings just to meet basic living expenses. The geographic inequality created by this employment recession will reshape American politics and society. Rural areas that never benefited from the tech boom will still suffer from the tech bust as reduced consumer spending and federal budget constraints eliminate government programs and transfer payments that many communities depend on. Immigration policy adds another layer of complexity to the employment crisis. While legal immigration has been reduced, creating labor shortages in some industries, illegal immigration continues to depress wages in construction, agriculture, and service sectors. This creates artificial competition for jobs while keeping wages low in sectors where Americans might otherwise find employment. The housing market implications of employment recession are staggering. When people lose jobs or take pay cuts, they can't afford homes or maintain mortgages. This creates downward pressure on real estate prices in job loss areas while inflating prices where employment remains stable. Healthcare costs continue rising as employment and wages decline, creating impossible choices for working families. People who lose jobs often lose health insurance, forcing them to pay full price for medical care or go without treatment. The tax implications of widespread job losses extend beyond individual income tax reductions. When people earn and spend less, sales tax collections drop. When property values decline, property tax revenue falls. When businesses fail, corporate tax revenue disappears. Federal Reserve policymakers believe they can manage this employment recession through monetary policy alone, but their tools are ineffective for addressing structural labor market changes. Interest rate cuts and money printing inflate asset prices but can't create jobs permanently eliminated by AI. The international competitiveness argument used to justify automation ignores domestic economic consequences. Companies may become globally competitive by replacing American workers with AI systems, but this reduces domestic purchasing power and creates conditions for instability. Congressional response to the employment crisis has been inadequate and misdirected. Politicians focus on creating new spending programs rather than addressing the underlying factors driving job elimination. They debate infrastructure spending while ignoring that construction jobs are being automated. They promote education and retraining programs while failing to address that AI is eliminating the jobs that retraining was supposed to prepare people for. The student loan crisis intersects with the employment recession in devastating ways. Young people borrowed hundreds of thousands of dollars for college degrees that were supposed to lead to stable careers, but those careers are being eliminated by AI before students can even enter the workforce. They're left with massive debt loads and no way to generate the income needed to repay those loans, creating a secondary financial crisis that will require taxpayer bailouts. Corporate stock buyback programs reveal the true priorities of business leaders during this employment recession. Instead of using their cash to maintain workforce or invest in job-creating activities, companies are borrowing money at low Federal Reserve interest rates to buy back their own stock, which inflates share prices and increases executive compensation tied to stock performance. The defense industry continues hiring while civilian sectors shed jobs, but these are predominantly government-funded positions that contribute to federal deficit spending rather than productive economic activity. Military contractors benefit from increased tensions and conflict spending, while private sector employers eliminate positions to cut costs. Energy sector employment faces disruption from both AI automation and policy pressures toward renewable energy. Traditional energy workers are losing jobs due to efficiency improvements and reduced demand, while renewable energy jobs require different skills and are often temporary construction positions rather than long-term operational employment. Financial services employment is being hollowed out by algorithm trading, automated customer service, and digital banking that eliminates the need for human interaction. Bank branches are closing, insurance agents are being replaced by online platforms, and investment advisors are being displaced by robo-advisors that manage portfolios automatically. The most disturbing aspect of this employment recession is how it's being normalized by media and political leaders who have insulated themselves from its effects. When journalists, politicians, and policymakers can work from home, collect stable salaries, and benefit from asset price inflation driven by Federal Reserve policies, they have no personal incentive to acknowledge or address the employment crisis affecting working Americans. But here's what every working American needs to understand. This employment recession is not a natural economic cycle that will eventually correct itself. It's the result of deliberate policy choices made by people who benefit from high asset prices and low labor costs. The Federal Reserve's money printing benefits asset owners at the expense of wage earners. Corporate automation strategies boost stock prices while eliminating jobs. Government deficit spending funds transfer payments to politically connected groups while creating inflation that hurts working families. The question isn't whether this employment recession will get worse, it's whether working Americans will recognize what's being done to them and demand policy changes before their economic situation becomes irreversible. Because the same people who created this crisis will be the ones offering solutions that protect their wealth while asking working families to sacrifice even more.